afternoon to those of you tuning in from Europe, and good morning for those on the other side of the Atlantic. My name is Evir Mishin, and I lead the health sector at the Foreign Trade Administration at the Israeli Ministry of Economy and Industry. And first, I would like to thank our partners at Health.il and at the Israeli Export Institute that together with Ofer Forer, that leads the investment promotion at the Foreign Trade Administration, helped to co-organize today's webinar. Israel's health tech sector is one of the strongest pillars of our startup nation. In fact, over 23% of the Israeli tech ecosystem is made up of medical devices and digital health companies, spanning the entire health tech spectrum from drug discovery and diagnostic to acute care and mental health. A key factor driving the success in the deep integration between startups, hospitals, HMOs, and government bodies. This creates a unique environment where companies can quickly pilot, validate, and bring to market innovative solutions. At the Foreign Trade Administration and the Ministry of Economy and Industry, we're proud to support this ecosystem together with our partners in Israel. Through our global network of over 50 trade offices, we are actively connecting Israeli health tech companies with investors, partners, and customers. We do this through investor meetups, networks events, roadshows, and by hosting national pavilions at major international conferences, just like HLTH recently and Medica that will happen in November. And in today's session, we'll give you a closer look at the health tech opportunities Israel offers. If you'd like to explore more, I encourage you to connect with our nearest office, wherever you are, and you can find them all at itrade.gov.il. So thank you, and I do hope you enjoy this session and you will find it fruitful. And I give the floor and the mic to Karim from the Israeli Export Institute.
Hi, everyone. Thank you for joining. I'm Karen Moore. I'm Director of Health at the Israel Export Institute. I'll support, of course, what Ev just said before. But what we basically do is we promote the export of Israeli companies, technologies, organizations, devices in various fields, especially in health. Israel's health ecosystem is one of the strongest ecosystems in the world. We have, as Ev said before, we have a growing community of startups and organizations, ideas, technologies that go abroad. It began with medical devices years ago, and today we are very much pleased to learn and promote the export of digital health coming out of Israel. I encourage you to explore the Israeli ecosystem, to investigate it, to learn more about it. If you have any questions, if you have anything you would like to follow following this webinar, if there is anything in particular that interests you as an investor, we strongly encourage you to join us further down the road in HLTH, USA, in Medica, and other roadshows and delegations we carry out, and get to know better the Israeli ecosystem in various verticals, therapeutic areas, and categories. Thank you for being here.
Okay, we can just jump in and dive in. So Yoav, the floor is yours. You're on mute, Yoav.
So this is a very special session for me, and I thank you for joining. This is something we wanted to do live in Amsterdam at Health, and I'm very happy that we were able to convert this to something virtual. So 3 quick things before we begin. The first is that we all know it's been a very tumultuous last year, year and a half, so I greatly appreciate you taking the time and effort to join us for this. The second thing that's important is that the whole concept behind this started from the fact that investors are frequently invited to all these conferences where they sit on the panel and then they get pitched by startups. But no one ever actually speaks to investors about what's going on in their world. And that was really kind of the kickoff of having this event. This is something that I've been wanting to do and explore for a long time, to really speak to investing entities about their macro level things that are going on. And the last thing that I want to say is that for me personally, I think healthcare and succeeding in healthcare innovation requires a very deep, nuanced understanding of the complexity of it. We expect this from the founders that we invest in, that they understand this complexity. So therefore, same thing goes for us as investing entities, where really the more you know, the better we can be. And that's what this is all about. So I'm going to go over the four things at the top very quickly on purpose, because I want to get to our panel at the end, which is really the important part, and they're here as the stars of this show. So I'm going to go over kind of 2024 investments in Israel, good, bad, and looking beyond it, and then talk about these macro trends. And I'm starting with Israel first because it feeds into the macro trends that we're going to talk about on the panel. The panel is dynamic, meaning you as the audience get to participate. I'll give you more details about that later. So let's begin with a quick recap of 2024. First, at the very, 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 very highest level, certain things are interesting about the Israeli ecosystem as a whole. First, it really does have the highest concentration of AI talent per capita, and it does have the highest amount of R&D from a governmental perspective as percent of GDP. These things are true. In addition, Israeli founders are well known to be very critical when it comes to creating unicorns. Tel Aviv University and the other universities in Israel are pretty much the biggest source outside of the United States for unicorn founders. Now, this is all well and good, and this is also true, but it's not really bankable. And we need to translate this into something bankable. And this is where we're going to start looking at stuff that's deeper. What's interesting to me, 2024 actually increased in total health investments by about 5%. This to me is very unique considering the challenges that happened here. We can see it on a deeper level at the quarterly perspective, where 2023, the fourth quarter, and the first quarter of 2024 saw major hits in investment activity, and rightfully so, right? The risk profile in Israel was significantly higher. But that bounce back was very interesting and positive. If we look a little bit deeper, what happened in 2024 that I think is very interesting is that if I look at core investment activity, which we define as named price rounds, all three of them increased, especially early and mid, which to me is really a testament to the startups that were built out in 2020 through 2023. And here's just a number of examples. All of this happened in 2024, and this is just kind of a small portion of all the activity that we saw in 2024. When I look at other alternative investment activities, there was a decrease. I actually think this is positive. And the reason for this is because grants and debt and extension rounds, and also things like pipe deals, they are used highly when there's a lot of uncertainty. So that shift from alternative investment activity to more traditional core investment activity is actually a positive signal. It means that investors are moving back to the table, and startups are less reliant on things like grants and debt and various ghost rounds or undisclosed rounds. So I think this is positive, that shift. The other thing that was good is that the ratio of international to domestic investing entities stayed the same. I track this a lot, and typically there's a one-to-one ratio between foreign and domestic investors. Obviously, the earlier stages are going to skew much more domestic, but surprisingly, in 2024, that ratio stayed the same. This is a welcome sign to me because there was a lot of hesitation here in Israel that foreign capital would not come to the table in 2024. Another interesting aspect is formation of new startups. For health in general, this has been on a global decline since the ZIRP COVID peak of 2020. We've seen this everywhere, also in Europe. and also here in Israel. But Israel is still producing new health startups at a faster pace than the US, even after 2020, and even over the last 2 years, which really is kind of the impetus that necessity really is the mother of innovation. The last thing to me that's really interesting and positive is capital efficiency. There's this general perception that Israeli startups are able to produce and iterate faster and more efficiently than their US and European counterparts. And to me, what was interesting is that the data actually shows this is true. Israeli startups in healthcare, on average, are able to reach critical fundable milestones at a faster rate and with less needed capital, making for more capital efficiency. I do want to call out two categories from 2024, and I mention them because they're on trend and they're going to be an integral part of the next decade of healthcare, specifically personalized and precision therapeutics. Drug discovery and pharma optimization. These are words that I created, right? There's categories that I kind of looped in. Drug discovery really is these integrated systems and technologies or methodologies to develop new pharmaceutical compound. And pharma optimization is the products or services that help these pharma companies become more efficient. The real kind of difference between these two categories for our purposes here is that drug discovery really touches the molecule or the biology or the chemistry or the compound, whereas pharma optimization helps others do that more efficiently. I'm seeing this trend continue in Q1 2025, which is great, that these two categories are showing continuous signs of progress. But there are issues, and we need to be honest about these issues, and we need to understand where these issues come from, because only by understanding them can we understand how to maximize the opportunities. This is the first issue. I hear this from every single health tech founder in Israel, and I define health tech as software-driven, software-only products and services in health, what's traditionally called digital health. I hear this from everyone here in Israel. I hear this from a lot of founders in Europe too. And I'll be honest with you, I hear this from many health tech VCs in Israel as well. But there's two aspects to this. One is this word smart, and the other one is this word seed, right? Smart, as we know, is that succeeding in health tech innovation requires a deep understanding beyond just an algorithm and beyond just medicine. That understanding of knowledge and access and network and workflows and healthcare economics is critical for success. And as we said at the beginning, we expect these from the founders that we're going to back, but us as investors, we need to be up on this game as well. The other part of this conversation is the word seed. I talk to endless VCs who pretty much all say the same thing to me. We're interested in 3 to 5 million check sizes, late seed or A with traction. But this kind of misaligns. This misaligns to the exit values of health tech, and it also misaligns to the capital needs of early stages. And this creates this gap. If we want to look at it statistically, what's interesting to me, and I tack back to what we were talking about that ratio between foreign and domestic investors, the unique number of pre-seed and seed investors only actually increased in 2024 as compared to 2023. This really is a testament to these Israeli founders who hustled and worked their butts off to raise capital. But beyond that, I'm seeing that the amount of investors in 2024 in these early stages who have healthcare expertise actually decreased. And the way I look at it is by looking at who has someone on staff who really is a healthcare expert or who has made more than one-off investment in health. This raises some concern. This raises concern about if these startups will be able to get the support from their investing entities in that critical non-technical aspects that we were talking about. The other thing is this lack of capital and device. This has been a decade-long shift in the device market. I don't know who invests in device or not, but many of the large industry players who acquire these things have shifted, and they've shifted to later stages, and they're willing to pay a premium for these devices that are already proven. And this has created a shift in the investing entities as well, who've also moved to later stages. This creates this gap in early capital for device. In Israel, I'm seeing it here. Many devices receive a lot of grant support from the Israeli Innovation Authority, which is a welcome benefit of the Israeli ecosystem, but then they face this lack of capital support. So these devices turn increasingly to crowdfunding platforms to bridge this gap between the Innovation Authority grants and the next critical clinical milestone that's going to trigger investors. Crowdfunding platforms are okay in certain scenarios, but for device, they create issues. They create significant cap table complexity that could be a turnoff for VCs later on. And they typically do not give enough funding to get to these critical milestones for device. The percent of private capital going to traditional early stages devices has been on a steady decline for a long time in Israel. If you track this back 15 years, you'll see the percent is nearly 15. By the way, I also see the same trend happening in Europe. If you look at the amount of new device formations over time, you'll see a big drop off as well since about 2018. In pharma, I'm also seeing a lack of capital, but in a different way. Effectively, we need bigger checks. Reaching that critical value add inflection point is becoming more and more and more expensive. And I want to move from a candidate to that clinical POC after IND in phase 1 and 2, and that requires a lot more money than it used to. This is how we're seeing it here. The average money going to an A round for biopharma is double in the US than it is in Israel. Biopharma is expensive. So there's a concern that leading biopharma startups in Israel are not getting the necessary support they need to hit critical value add inflection points. Here too, in the misses, I want to call out a couple categories. Well, one specifically that I was hoping to see more traction, which is mental health, both neurotypical and neurodegenerative solutions. There's been a significant amount of governmental initiatives here in Israel for mental health support, but this has not yet trickled down to startups who are building unique value propositions. Funding remained flat between 2023 and 2024. This is definitely a space that I'm going to be tracking in the months and years to come to see if these government initiatives do foster some more activity in the coming years. There still are diamonds in the rough that are showing excellent traction. I want to call out two. Elios is building an automated back-end operation for mental health clinicians to reduce administrative burden and documentation and compliance. They raised over $120 million, including very recently a few months ago, and they're making excellent progress. Agave is newer. It's focused on adult ADHD care and support. They're making excellent traction through their deep understanding of how to tap into employee-sponsored healthcare plans in the US, which is a whole beast in and of itself. So where are the opportunities in this? How can we take the good plus the bad and try to tease out ways to be effective and to tap in and maximize opportunities? So let's look at these by these issues. Regarding issue 1, I do see opportunity for smaller niche funds who are able to deploy capital in a way that is aligned to the early stages and to the exit values of health tech. I'm seeing an emergence of these kind of niche micro funds in the US and who are hyper-focused either on the stage or on the sector. And there's also opportunities for funds who are willing to push business avenues beyond just growth. Roll-ups, early acquisition, joint ventures, strategic partners with larger incumbent startups or with corporations, etc. I also see a benefit specifically in Europe in this vein. Early stage startups that could be complementary or supplementary value add bolt-ons for the incumbents or for large startups, but also on the later stage, these startups who've settled on their product market fit in the US and have strong business models that actually align with how European healthcare systems work. In between is going to be difficult. These startups are going to be most probably dedicated to building themselves out in the United States and probably do not have the capacity to deal with a whole other continent. Devices. There's definitely opportunity for those investors who are strategic or semi-strategic. We're open to pushing for early acquisition. I'm actually noticing from my conversations that there are a lot of small and mid-cap device companies who are recognizing this shift of these majors to the later stages and recognize that this opens up an opportunity to acquire early at a good price. So funds that have these connections can find opportunities in Israel to tap in at a really good price point and pursue early acquisitions. With biopharma, it's easy. There are a number of excellent biopharma investors here in Israel, and best way to do it is to just co-invest with them directly. They're here on the ground. They see the viable opportunities. Happy to connect you. I do want to point out something unique. There are actually opportunities in Israel for the portfolio companies for investors abroad. The first thing is trials for anyone who's in pharma. I recently dug out from clinicaltrials.gov and found out that 65% of the top selling assets in 2024 did a pivotal or critical trial in Israel, somewhere from phase 1 through phase 4. And as we're seeing in the US, that the whole trial activity is kind of in upheaval because of budgetary cuts and uncertainty. These startups may be looking for a better location to do it, and Israel could be an excellent site for that. Same with Europe. New recent regulation in Europe has created also a lot of uncertainty. So there is an opportunity for your portfolio companies to actually trial here in Israel. And there's also a lot of opportunity for doing clinical validation and piloting here in Israel, specifically in areas where Israel has unique value add. Anything in women's health and care continuum for women, value-based care and value-based specialty care for sure, pediatric innovation, anything requiring real-world evidence. And there's also really unique situations. Inflammasense and Sana are actually two startups from the US who are both doing PTSD, who are actually currently conducting clinical validation in Israel. Inflammasense is from San Diego. They received $6 million from DARPA to study the interaction between the vagus nerve and inflammation and mental health. Sana's from Colorado. They're building a solution for PTSD based on neuromodulation. So they're both here in Israel, effectively for all the wrong reasons. Currently, right now, for what we already know, there's quite a lot of data on PTSD, specifically in women. Women in PTSD is an area that has really barely been studied simply because there's a lack of data for it. And from the Israeli healthcare system here, if there's a way to take these last 20 months and help citizens globally, this is the way to do it. Again, necessity is the mother of innovation. And so these two startups are working in conjunction with the Israeli hospitals here to build out solutions that could potentially help people around the world. Behind all of this, there are very large megatrends. And here we're going to get into our panel in a minute. And I want to talk about three major shifts that I'm seeing. This first major shift is this continuous move of LP money going to a really small select group of mega funds. In 2024, there were 9 firms and only 9 firms that raised 50% of LP money. And these mega funds are starting to operate more and more as basically boutique investment banks as opposed to the classic VC model we know. They're registering themselves as first full service RIAs. They're making completely different plays than what we're used to. General Catalyst bought a hospital recently, which was effectively kind of this leveraged buyout deal, which was very unique. But these mega funds, because they're so big, require mega returns. And that raises a question if the vast bulk of startups, even the really good ones, are able to raise money from these types of funds because the market that these startups play in may be just too small to even move the needle for these funds. The second shift is this discrepancy between private and public valuations in healthcare innovation, specifically in health tech. This chart is fantastic. It's from What If Ventures. It shows the enterprise value of public healthcare companies, disruptive, they call them, as compared to forward-looking projected yearly revenue. And you can see really easily that healthcare is not trading at the same rate as the wider market. This is obviously going to impact LPs because they're going to struggle to understand where they're going to get their returns from. This may be improving. The stock price of Hinge has been steady and even improved since their IPO a month ago. Um, and Omada less, but we'll see what's going on with that. And the last thing is here. This isn't so much a shift as I would call a reality check. Most exits are through acquisitions, as we know. There's a big variance in the three different sectors of health. And this is obviously going to play out if I tie it into these mega funds at the beginning. So this kind of begs the question, is healthcare investing in the traditional sense even effective anymore? Healthcare, specifically health tech, but also device, may not have the exits that are relevant for these massive mega funds. And are we all kind of all dependent on them, or are there different vehicles? Are LPs even interested in health tech given the underlying disconnects and evaluation? So to address this, our incredible panelists are going to do this and join us for this. Before we begin, I will say that this is dynamic, meaning I'm going to ask questions to the panelists, but I'm also going to ask questions to you, the audience. If you would like to respond, you'll see a raise hand. Raise your hand. We'll call on you, introduce yourself, tell us which fund you're working with. And that's on purpose. This is to get you guys all involved and get you interested in this topic, and we would love to hear from you. So I'm going to stop sharing and we'll get started. Okay, so before we begin, I would love for the three of you to introduce yourselves. I'm starting with whoever is right below me, which is Roy.
All right, so hi everyone. I'm very excited to be part of this panel, even though it's on Zoom. And great, thanks very much for the invitation. So I'm Roy Wiesner. I'm a partner with Amoon. Amoon is a life sciences and health tech dedicated VC. We invest across the sector. So we do therapeutics, we do diagnostics, we do digital health, we do device. We also invest across stages. We have an early stage fund, which is where I spend my time, that invests from pre-seed up to round A. We have a growth fund that invests from B round and north. And we also invest globally, which means we see the deal flow, everything that pertains to what Yoav has just shown regarding the Israeli market, but also we invest in the US and Europe. So I think we have a good bird's eye view of what's going on across the industry. In total, we manage about a $1.3 billion. We're headquartered in Israel, but we also have an office in Boston. So that's in a nutshell.
Moving to you. Elisabetta?
Hi everyone, thanks Yoav and all the team for the invite. Very, very happy to be here. So on my side, I am Elisabetta. I work for Planven. We are a VC fund based in Zurich and Tel Aviv. Myself, I'm based in the lovely Zurich. We are a fund with 300 millions of asset under management, investing across Europe and Israel, obviously, but also US. In general, we are B2B SaaS investors, so no hardware, no devices, and health tech is one of our strongest verticals. But as I said, so we don't do devices, so also like no wet lab, no wet science, really either digital health or health tech. In terms of tickets, we are also now raising our next fund. We are going to do around 10 million tickets. In terms of stage, we can be flexible. I would say that the sweet spot is between A and B, but said that we can go lower, we can go higher. Obviously, the letter of the alphabet really changes based on let's say the geography. We tend to lead and co-lead, so have governance, board seat, and be very active with the companies. Thank you.
Okay, Joel too.
Hi everyone, I'm Joel or Joel Shopik. I am with OSE in the UK. Moved here recently from the Tel Aviv ecosystem, where I was at a fund called Pitango before, and then many years on the startup side at a company called Healthy.io. OSE is actually quite an interesting model. It's an evergreen investment company with about 1.2 billion assets under management, investing in deep technology, so health tech sector, The team that I'm part of, we do anything from medical devices, digital health, therapeutic platform, so kind of AI intersection with diagnosis, life science tools, etc. Importantly, we build a lot of things as well. So we will do active venture building with technology coming out of Oxford, and our capital structure enables us to be quite flexible. So can do, $500,000 into kind of exploring something and building it out, to 30 million into, we did a 30 million round recently in a medical device company that we kind of spun out of here. So quite a lot of flexibility, and have touched on different elements of startups and investing in across Europe and Israel, and most of our companies focused on the US ultimately. So a lot of the points you raised definitely top of mind.
All right, you ready, you three? These questions are going to be, well, they'll be free for all unless I call on you specifically. So I want to first talk about this LP issue and LPs not being satisfied. They're waiting and waiting and waiting for their liquidation, which is taking longer and longer and longer. And even when it does happen, their results are less than what they wanted, or less than what they expected. So my first question is, are you guys sensing any LP anxiety at all within your fund? This is open to anybody.
I'm happy to be the brave soul who will go first. So there is difference, first of all, between the type of funds. When you're dealing with an early stage fund, I think LP expectations are equally calibrated. Nobody expects to see exit after a 3 or 4 years average holding period in an early stage fund. What they do want to see is that there are indications, that you have sort of the runaways, right? The ones that could have the potential to really make an outsized return. And this is through when we see, full-on rounds with higher and higher valuations. So obviously it's not yet DPI, but it is an indication for the LPs that things are going the right way. When you're dealing with growth fund, it's a different story because they come in already expecting to invest in assets that should produce the exit or the return at a shorter time span. And there, of course, you will see more, use the word anxiety. I would just say, there is more scrutiny of what's going on. And, the way we also address that is you need to show the value catalyst, a sort of short-term, mid-term, long-term, to help LPs understand where the asset is going through. It's not just enough to say, well, this is currently the situation. They want to understand where it will be a year from now, and 3 years from now, or 5 years from now. At the same time, at least for us, they have seen exits, some better than others, but they have seen areas where the thesis has played out. So in that sense, this is also part of what they're looking to see, that the investor, the fund, understand the space, that they have thesis that works out. Of course, some theses do not pan out as the way we want to, but then I think you should really differentiate between the early stage LP and the growth stage LP.
Yeah.
Yeah.
Go ahead, Elizabeth.
Please.
Yeah, no, if I can follow up to what Roy was saying, right? I completely agree. Also, in our case, we have the early stage funds, and then essentially we also had continuity fund, and obviously the expectations are different. On our funds, let's say that ourselves as GPs, we are not essentially pressured in our cases, because we also had exits. So again, based on the vintage, there is not an expectation at the moment for these funds to be fully sold. But that said, sometimes we can also suffer, right? If on the LP side they have some liquidity needs, because besides investments in our fund, obviously the market has not been the best, and so they may have suffered, right, from others' investments, and so they might have liquidity needs that then obviously are reflected in terms, for example, of a new allocation, right? So we are raising now a new fund. I would say it's going well at the moment, but at the same side, it's not always the easiest, right? Because many conversations that we have with LPs that also may not be our LPs are like, we would like to do it, but at the moment we will need some exits. We don't have dry powder, and so maybe, right, we will need some exit to actually be able to deploy again. So that is something that more as an anxiety, right? Is more as a fact that sometimes there is really a liquidity need that obviously prevent them from doing, for example, other investments or new commitments.
Yeah, I'm maybe jumping in on that. Definitely, I think everyone is somewhat anxious on capital, but I do believe it's important to also not forget that the whole category of digital health and health tech isn't that old. And the sense that I got, particularly over the last few years, is that a differentiated product, if you will call that, resonates really well. So I think there was kind of COVID, a lot of money generally flowing into health tech. Valuations were really high, and then a lot of investors kind of got their fingers burnt to some degree. But I think people that invest in health tech funds understand to some degree that healthcare is massive. It hasn't been cracked yet, but in the future it will be cracked. It will get cracked, and you do need to have health tech expertise, and you need to have local expertise, right? If you want to invest in Israel in early stage, you need to have people in Israel at the early stage, or in the UK, or wherever it may be. So definitely feel quite a lot of positive sentiment on, let's call it, the category of earlier stage health tech investment. I think the less differentiated you get, the more you compete with others on general growth, obviously becomes a little bit harder. I think portfolio construction becomes really important. Can you show something that gives you sort of DPI a little bit quicker, that gives everyone patience to stick with you for the longer term? We had a exit not in healthcare, in quantum computing 2 weeks ago, which sort of gave everyone, like, if you can make money out of quantum computing, then maybe everything else will also work out. So how do you buy yourself some goodwill with some good exits, and you invest in companies, to Roy's point, that what we know now, and we're going to be a bit more careful, but like maybe in 3 to 5 years we can return some cash, and then we're going to do something that's going to take 10, 12 years and balance it out.
Yeah. So I actually want to talk to the three of you about returning cash, right? And DPI, and kind of ways to jigger that entire model, because the mirror image to all of this is this huge rise in secondary funds. I whipped out the stats. Secondaries raised over $100 billion secondary funds in 2024, and over 50 billion just in Q1 of this year. And we're seeing a lot more VCs who are quietly using this kind of secondary mechanism to create this liquidity for LPs. Sometimes this comes with a price, a discount, the paper valuation, whatever, but I'm also seeing startups utilizing this. A great example is Jane, which is a unicorn startup out of Canada that sold $500 million of their own shares in the secondary market a couple months ago. So actually, Elisabetta and Joel, I had a question for you guys. Are people even exploring this secondary thing in the European health kind of ecosystem?
Maybe I'll go first. My sense is not that much, but I'm also wondering how many companies are there that could make a really strong second, like how many healthcare companies are there in Europe that are at a growth stage where they could have a really attractive competitive secondary offer and people wanting to invest in it. So I'm not seeing it that much. There is on the margin, definitely, but I think secondary funds sweeping in and trying to take a big chunk in a healthcare company, like, it's hard to raise, right, for most companies. So it's not like there's a ton of optionality if you're a growth stage European healthcare or Israeli or even US healthcare companies, with a few exceptions. I don't think there's people biting off your hands to buy secondaries, but I'm not sure what if that's like my narrow perspective from what I'm seeing, but not sure if Elisabetta or if you guys are seeing it differently.
Yeah, I mean, on a broader level, for sure, also from conversation with other funds in general, like secondary is something that people are pursuing, and not just through traditional secondaries, but also through different kind of secondaries, like GP-led secondaries, continuation funds, where essentially LPs can decide if rollover or essentially sell their stake. So it's something that essentially I hear, right, from different conversations, and it's something that we can see, let's say, also in numbers, right? Because in terms of discounts are narrowing, at least in the last 2024 versus the previous year. So in venture, probably now LP portfolios are trading at like 75% of the NAV or something. So let's say this obviously then helps saying, okay, we can essentially consider secondaries as an exit, right? Instead of having zombies portfolio. Now, that said, also to Yoel's point, we will need to get more probably into data, specifically into healthcare, right? Because obviously when in terms when, for example, I was reading that if you take big and growth stage companies in healthcare, where, for example, discounts are very, very minimal, like even 5-10%, because these are amazing companies. So once you get there, it looks like you're still in a good position that even, yes, it's even a secondary, but still like is like, a very, you're in very good position. Whilst on the other side, maybe on the earlier stage, when we see discounts of even 10 or 20%. To your point before, right? It's not an easy market. No, the exit values are not huge. Probably the average is between 200, 300. Obviously, sometimes it can go higher, but I also understand that if some funds needs to close the funds, and you cannot keep zombies, and you need essentially another way out.
Yeah. Loy, I want to ask you about the activity in Israel, and I'll tell you why. There was an article this morning in Kalkalist about secondary funds, whatever. I do not know of a single fund in Israel that's actually utilized this mechanism. So do you think Israeli investors are utilizing secondaries at all?
I'm familiar with a little bit of secondary activity. I want to tie it into something bigger, which I think is, we need to look at the market and see where it's heading. So you mentioned before Hinge and Omada. Um, once we see an IPO window that starts opening, everything affects everything, right? I mean, in this universe. So we are investors through our growth fund in Omada, and I think that once the sentiment changes of, okay, IPO is a viable option, especially to Joel's point before, that we're dealing with a new category of digital health. Where is it going? How would exit look like? Will it only be through M&A, which currently is sort of the modus operandi, or is IPO a reality? And what do you need in order to get to an IPO in terms of revenue, in terms of the amount of money that you raise? So I don't think that, to your question, that secondaries is not big in Israel, but for top performing companies, and I think more so on really the pure tech side, which investors can relate to, the performance of other secondaries in other market. We see a little bit of activity, and it may actually increase.
So I actually want to continue on what you said right now about this IPO window. And I agree with you, like maybe it's opening up, Hinge, Omada, wonderful. I also think that the early M&A window is opening up a little bit. I personally think that early M&A opportunities are very underutilized in general, especially here in Israel. And I'm wondering if any of the three of you are exploring that pathway as investors about, investing in something in health tech, whatever, and finding a way to push it out for, not a 20x, but like a 3 to 5x within, let's say, 3 to 5 years. Is this something that's being discussed even?
I think
Yeah, go ahead.
I think the realities in healthcare that because it depends what you call an early M&A. I think the healthcare market is naturally one where you're probably going to aim for more, 5x M&A exits and not the 2030 power law exits that you maybe have like in traditional like Silicon Valley VC. Now, if you think early exit basically mean I'm going to do 2 years, and depends on fund structure, I'm going to get like I'm selling it for 30 million. If I have a fund of 150 million, or if a billion, it's never going to work. It's never going to make sense. But saying I'm going to from the beginning aim to invest in something where that's going to sell for 300 to 500, and I kind of a number of those winners, I think that's probably a very sensible strategy. I think waiting for things to IPO or be massive M&As, there's just not a track record in healthcare of having $10 billion companies so that you could look for the 100x fund returners.
Yeah, I mean, no, please, Roy, go.
No, go ahead, Isabel.
Yeah, no, I mean, following up to what Yoel said, right? I think we need to be realistic, right? And see what's actually going on in the market, average multiples. It's not like in health tech. Then obviously it depends. Some companies like more on the med tech side, or maybe with life science, or where there is some super strong technology, even with a few million ARR, you can get acquired for 600 plus. Like we had one company, CAFWorks, where we're super happy about the exit. it, right? But it's not that there is an acquisition like that every time. So you need to be realistic and think, okay, this is a company it's going well. It's probably has, hopefully good technology. Multiples are what they are, right? So even when we invest, it's not like we think necessarily this is going to be the $1 billion dollar company, but let's hope at least on the 500. Let's understand, right, what are the chances potentially also to get out of this, also not in 10 years if you're not a life science evergreen fund, right? Because we are not, we are a closed end. So these are all essentially considerations that you need to start doing. And obviously on the on the trend of the micro funds, right? These potentially can have sense. You do more sort of a spread and pray, and then you hope. This is not our strategy, by the way, but I can understand, right, this strategy.
So, we're in the business of returning money, right, to investors, which means that on an ongoing basis, we need to evaluate the potential return. And sometimes the right thing to do is to sell early. Some companies, you realize that what it will take for them to be acquired based on a certain sales multiple, it will take a long time and a lot of money. It may also not be necessarily their strong suit on building out a US sales team, etc. And then if you have the opportunity to sell early, and we say, okay, this is it's a good enough return, and you go there. Some other companies, I think, and that's particularly with the ones that you see them as potential fund returners, you always have many sort of potential exit opportunities that precede the really large exit. We sort of see it time and again. You're approached, you could potentially sell, then you decide to hold. And it's a matter of balancing between selling too early and selling too late, which we've also seen, right? So sometimes during, let's say, 2020, 2021, when there was a hype and you thought the valuation would continue to increase, and in some instances, you left stuck with valuation that go nowhere. So I think it's a combination. I think every fund must always also consider early exits. Sometimes it makes sense. It also ties into valuations. Going back to your presentation about Israeli companies doing more with less, typically it also ties into lower valuations, which means that you can sell earlier and still see a nice return out of it. So it's a combination.
Yeah,
curious.
I'm sorry, Joel, go for it.
No, I'm curious what others think, but I think in the health tech space, it's also quite hard to early on predict sort of an early exit strategy. Like a medical device, there's very clear patterns. You can understand what is the potential market. There's like 5, 6 potential acquirers that could, buy your medical device. I think if we're looking at health tech, there's, it being a new category, there's a bunch of like Hail Mary Amazon acquire, like, kind of acquisitions that have probably created some big returns at like One Medical, or then you have the Livongo Teladoc, and then that collapses. Like there isn't like now with Hinge and Domata coming out, maybe there's starting to be more public companies that can then acquire you again and build out their portfolio. Most of the companies that IPO'd at the peak and are now trading below their IPO value. So it's quite hard to early on say I'm going to build a digital health or a health tech company, and then if I just get to this point, then probably someone can buy it, because I just don't think that predictability is there yet. But I don't know. That's how I feel about it. I'm not sure if others are smarter on it.
I mean, like from my perspective, I'm going to jump in on you guys. I actually think there's incredible opportunity for tiny little funds, just health tech, right? Like 25, 40 million cap, where you're really kind of investing aligned with this exit value. And you just say to yourself, okay, the exit value is going to be max, $80 million for this thing. And if you can align it and try to push it out within 5, you can, and I think Joel, you said this exactly, like, so these are things that I would love to see more of these kind of, I don't want to use the word alternative investment models, but different strategies, and I'm seeing a little bit of this, right? Like the story of 11.2. I don't know if you guys know this. 11.2 is this tiny little fund that invested in Hinge. And they're one of the biggest recipients from the Hinge IPO. And 11.2 is this tiny little fund that basically did that, invested really early, and all of their follow-on went to just Hinge, right? Which is extremely risky. They effectively said, we're not going to diversify at all. and we're just going to continuously back this one thing. And I think, this 30-40 million dollar fund just made $200 million off of the Hinge IPO or something. It's an interesting story. Um, so
It's
I
a
want
great
to,
story when it works, right?
I know,
Because
I know,
we
I
can also
know.
give you 10 other stories that don't make it to the news, but where you fall flat on your face. So,
No, obviously. I just thought it was interesting that like I do think that there's space for, especially when we talk about this very early gap in funding for both device and health tech for much smaller vehicles that are able to deploy,
yeah.
up to 3 million, not in that 3 plus, but up to 3 and that's it. Okay.
You
So
have, if I may, I think there is but a difference between the sort of the pure software health tech and the device.
100%.
I think the problem with the device is what you see is that companies are not rewarded for almost any milestone, until they really get to the market with a product and start selling. And this is why you see this gap because early funders tell themselves, right, I will come in, bear all the risk. The company will get an FDA approval, and the valuation will basically stay the same. So I will get diluted along the way because you still need to raise, money for the clinical trials. This is not pure software typically, and this is why you see the gap. When you talk about the hinges of the world, if everything goes well, valuation rises steadily from one round to the next. So the model of coming in early, small check, even when you get diluted, really works out. So these are
Yeah.
really two very separate areas.
I think there's also a
Uh,
benefit in health tech specifically because there's massive variance in the business model. Like you can play with the rollout in ways that do not exist for device and not for pharma. Pharma, you do a phase one, it works, phase two, phase three, et cetera. We all know the game plan. I think there's a lot more flexibility in the business models of health tech that offer significantly more opportunities.
I think the on the health tech piece, back to my earlier point, the acquirers are harder to predict. So if you say I'm going to build a mental health to some of the examples, I'm going to build a mental health tech platform. You basically have to build it in a way that you're saying either way, I can have this just as a cash flow break even business and it can kind of become its own little thing, independent if someone acquires me or not, and then maybe private equity is going to acquire it. But there's not, here's the 5 people, if I just get it, Talkspace are probably going to buy it, or Optum
Better
are
help
going
or
to buy it.
whatever.
So it's
Yeah.
quite hard to predict how do you plan for a 50 to 100 million exit in healthcare? I don't fully know yet. Yeah.
Yeah. Yeah. I want to ask the three of you just one final question, then we'll open it up to everyone. Um, it's been a really bizarre, year. All these really high level macro stuff and uncertainty and Trump and tariffs and there's elections all over Europe and China and this and that and all this stuff is going on. Is this trickling down to your operations at all? If not, that's great.
I'll I think there's some practical pieces. On the one hand, you could definitely see a bit of a shock initially with some of the both FDA decisions and the NIA funding cuts in the US, where a lot of life science companies and suddenly had a expenditure freeze, and companies that selling into that were struggling. So I think that was sort of a very tangible initial reaction. Interesting enough, a lot of the companies then got FDA quite quick, but we had a number of companies that were literally caught out by the reviewer was fired that was supposed to give them an answer in a few days.
Yeah.
And then I think also, which is probably partially a macro trend and partially linked to all the stuff we've talked about now, sometimes I feel like we're sort of in two parallel universes in venture, where if you listen to the general like Gen AI hype and general venture, people talk about I'm going to give a term sheet in 24 months, 24 months, 24 hours.
24 hours.
Yeah, exactly. So there's incredible hype on the one hand, and then on the other hand, it feels like in the bread and butter, let's call it health tech or most of the portfolios, people are incredibly cautious. There's not a ton of urgency to get stuff done, and people sort of want to see how both healthcare plays out, but also the geopolitical and the U.S. Political environment play out and how that's going to affect things. So that's sort of some friction that I definitely feel where just over the last few years, no one's been in an incredible urge to get things done.
So I think it definitely there are impacts on across different areas. So for example, when Trump, the new budget affects Medicaid, Medicare budget. This will trickle into portfolio companies that are selling into markets that rely heavily on that type of sources of capital, right? So you can't escape it. At the same time, I think it also opens up opportunities. So if you look at the fraud, waste, and abuse, if you look at economic efficiency of how do you price drugs better, then startups that are focused on that suddenly have this tailwind of going into the market and a lot of interest from investors. So you can be on either side of the story, but it definitely affects. Obviously, if when tariffs, who knows where this is going, but it can impact if you're invested in a hardware company, then now you need to calculate something on top of whatever budget you put in there. But on the other hand, if you were planning on M&A to the U.S. market and you're up against several Chinese companies, so maybe now you're in a better position
Yep.
because it's less likely that those will be acquired. So I think we're not just operating in a bubble where we're saying everything doesn't matter. We'll continue on, press on. I think we need to monitor things on an individual company level and make adjustment as needed based on whatever happens in the macro trend in the world around us.
Yeah, I mean, if I also, in our case, for example, we are only software investors, right? So tariffs obviously are not applied on the software side. So I would say potentially there was no a direct impact, right? It's very different if you produce chips in Taiwan with potentially a huge increase in tariffs or not. But at the same time, you can see indirect effects, right, still, because it can come from customers that at the moment, no, they might have maybe budget on freeze, and they're looking to understand what exactly is going to have their impact if they themselves, right, have obviously hardware, which is can be a lot the case in companies also on the medtech side, and with which our company are in touch that they have as a customer. So indirect impact, yes. In our case, direct, no. I would sum it up.
Okay, great. So I'm going to open this up to everyone. First of all, thank you, the three of you. This was, in my opinion, one of the most fascinating conversations I've had. I love talking shop about investing in general, as I'm
Better
sure all of you
conversations
know.
if this if we're setting the bar for you.
I know, I know. And I want to open this up to everyone. Feel free to ask questions, but keep in the back of our mind, kind of, what's this pathway forward? How can we as health investors stay relevant or more relevant? Should there be changes in the playbook given what's going on, and how are we supposed to act and look like? So this is open to everyone, Q&A. Feel free to ask. Just make sure to introduce yourself and where you're from first. Ev, would love your help with managing the questions.
Yeah, I'm waiting to see who's the
Yeah.
first brave one to ask the question.
Maybe in the meantime, so to get to buy people time, as they start writing questions. I just want to say this. I think actually healthcare investors are like dedicated healthcare investors are more relevant than ever. You showed, I think one of the slides was there was a decrease of the healthcare specific investors.
So you were paying attention.
I
Good.
was paying attention. It doesn't seem that way, but I am occasionally. And I think the reason is first, like with the rise of Gen AI, more generalists feel comfortable coming into the field, right? Investing in companies that are more akin to the other stuff that they're typically investing in. But at the same time, these companies will end up selling into the market that the three of us, now I'm talking about, Elisabetta and Joel, that's what we do day in, day out. And understanding the money flow, especially in the US market, is incredibly complex and requires, to your point on another slide where I was paying attention, for, the complaint of
Not enough
startups that's
smart
saying,
capital,
do we see the value from our investors where they see the value, and this is where we try to provide value, and I know Elisabetta and Joel is to say, to explain, where they should target, to think about the business model, to help open doors with the payers, with providers, with strategics, This doesn't go away. This actually becomes even more accentuated once you have so many new startups flooding in to when they rely on technology where technology is no longer the moat. So if technology is no longer the moat, what is the moat? And sometimes the moat is the access to the right sets of data, is the right go-to market. And this is where health tech dedicated investors excel. And I feel that now I bought enough time for everyone to write their questions. So I will shut up.
So actually, we wrapped up our hour. This was wonderful. I want to thank the three of you, and we'll be in touch. If there's any questions for anyone, feel free to email me. And thank you all for joining this wonderful Thursday afternoon.
Thank
Thank you.
you.
Thank
Thanks very
you.
much.
Bye.
Bye-bye.
Bye.